This is Alex Wright, and I'm with First Heritage Mortgage. We appreciate you giving us the opportunity to tell you about our market update and our topic of the week, which is how to qualify to purchase a home with only assets and no income. Before I talk about that topic, just an update on mortgage rates is that rates have been hovering around 6.75 to 7% the past 2 to 3 weeks. This is right before Thanksgiving of 2024. And we really think or believe that mortgage rates are going to stay close to 7% for the next 2 to 3 months. The Federal Reserve is meeting December 17th and 18th to decide if they want to continue to cut the federal funds rate. But overall, that's had a pretty negative impact to mortgage rates. Mortgage rates have been going up even though the Federal Reserve rate has been decreasing. And so we think that mortgage rates again are going to be around 7% for the next foreseeable couple months. When it comes to our topic about how to qualify to purchase or build a home with no income and only assets, first, the area that we primarily lend or finance property, being the Outer Banks, is a second home and investment market. And so it's super common to talk to borrowers that have accumulated savings in these accounts and are ready to deploy into their investment property or potential rental property to then future retirement home. And so it's a super common conversation that I have for the borrowers of close to retirement age, around 55 to honestly 70 years old. If you're not of that age, I still think there's some things that you can apply here in this video to help you purchase a second home or an investment property later in your life. I can remember when I got out of college in Orlando, Florida, I started working my first job there. I was at a sales job, basically making minimum wage. And, most of my colleagues were 22 to 28, and the conversation of retirement was definitely not on top of mind. But luckily, Drew kind of showed me different retirement vehicles of 401ks, regular IRAs, Roth IRAs. My brother is also a certified financial planner, and he talked to me about life insurance as well. And this is all, during that age of 22 to 24, before I'm even in mortgage. And so I kind of had already a background about savings and retirement before I got into mortgage. But when it comes to buying or building a secondary residence, I'm really glad that I kind of followed my dad's advice or my brother's advice about future retirement savings. Because, for example, if you want to buy or build a secondary residence, other than the cash needed at closing, there's your down payment, there's your closing costs, and then there's your total cash needed at closing. Other than that, other than the money spent at closing, you'll also need other funds, because people buying a secondary residence or investment property, they are required to have future payments just in case there was a hardship in their life where they couldn't make a payment for a small period of time. So it does depend per lender some, but it's common that the savings amount, and the savings amount is referred to as reserves, which is the money outside of your cash at closing, is can you make a future payment for 6 months? And so if your future payment's $5,000, underwriting may have a reserve requirement that says you need to have 6 months of $5,000 saved, if that's what your payment is. So it would be 5,000 times 6, that's $30,000. And that $30,000 can be in a 401k, can be in a brokerage account, it can be in an IRA. Now, there's different percentages of those accounts that underwriting would consider liquid, but it's still a great example that if your goal is to acquire property over a long period of time, if you want to own 3, 4, 5 properties, reserves are going to be a factor for any lender. Doesn't matter if you go to and kind of off the regular traditional loan route. If you go to for example, one of these rental income loans, like a DSCR loan or bank statement loan, those loans still require reserves. So you're not going to get out of this requirement unless you went to truly hard money or borrowing hard money, which is a whole different topic. But, just to reemphasize that really no matter how you want to acquire property over time, having these retirement vehicles are important, not just for being able to create income, but also being able to qualify from, an asset standpoint for if something were to go wrong. And underwriting is always going to have, for secondary or investment property, some type of reserve or future payment that's going to be a qualifying factor. So hope you're still thinking or asking, well, what about these borrowers, Alex, that are, close to retirement age, that don't have any income or have very little income? Usually they do have some type of pension or Social Security, but for the most part, they don't have, enough income to qualify for a $5,000 to $10,000 mortgage payment. And so how do they create income or get income even though they don't have any, they only have assets? And this is really applicable, especially for the retirement people that are a 59 and a half or older. And so if you are a 59 and a half or older, you can create what's called, especially with an IRA or a 401k, you can create a distribution. And so a distribution does have a calculation to it. You can't just take any amount of money. It has to continue, for example, for 3 years. The distribution has to show the ability and the intent for the borrower to continue for 3 years. And then they're not going to just take the whole amount of, for example, an IRA of $1 million, not just take the whole $1 million, they're going to take a percentage of it because it's invested in the market. So typically that number is 70%. So if you had $1 million IRA, that would be 700,000, and then you would divide it by 36, and that would be your monthly income to continue for 3 years. And so this has been a way that we've qualified or helped people qualify. They come to us with no income. We create this solution with an IRA, and all of a sudden now they can build or purchase their secondary residence or investment property. I've been using that solution since I was in mortgage since 2017. Another kind of evolution of time in my career is that, in 2019 and 2020, banks really wanted to be in the mortgage business. And so they really pushed some different calculators to use for assets. And you didn't have to be of retirement age in this 2021 and 2022, where money was typically around, almost 2.5% to 4.5%. And so they would lenders would basically use this asset dissipation calculator where it was super favorable to come up with an income number per month. And you didn't have to take a distribution at all. You didn't have to be of retirement age either. And you'd have this income stream that was a way to qualify for a primary, second home, or investment property. Since then, and really in 2022 and so on, banks, after the Silicon Valley Bank crisis, where there was just less consumers putting their money at banks became, significantly concerned about risk, and they took away these programs completely for most lenders. Instead, what's happened is that Fannie and Freddie, the government-sponsored entities that typically buy mortgage debt, they basically said, well, we don't really want to do this asset dissipation model, but we'll do what's called asset depletion. And first, when it comes to asset depletion, when it comes to selling the loan to Fannie and Freddie, you need to be of 62 years of age. They basically made a hard rule that you can use income from assets if you're 62 and if it's an employer-related asset. So they basically did that part of it. So they made it harder for you to be in this box, along with the calculator significantly less favorable. You really want to deal or broker to a bank for asset depletion because they can create exceptions if you're not of retirement age. So you might be able to do this if you have a large sum of assets and you're in your 50s, for example. And also the banks, it's still not as easy as it was in 2019 and 2020, but they also allow for a little bit more favorable income calculator where you can take that same 70% of that account. It doesn't have to be an IRA this time when you're using asset depletion. It could be a brokerage account. It could be just, an IRA, 401k, etc. But it can be either one. And you basically take that account and divide it by 210 instead. So what I've come up with recently is because, some assets are in brokerage accounts, some assets are in IRAs, and typically for these borrowers, there's a variety of different assets. is to actually kind of stack the loan where it would be an IRA distribution, and then also, the regular brokerage account, we do an asset depletion income as well. So you just really have to get creative in second home and investment markets, because borrowers just don't always fit the box of Fannie and Freddie, being 62, being an employer related asset, and dividing by 360 months is just, even if you have $2 or $3 million, just isn't that much income per month overall. So I hope this kind of gives you some clarity about why you, as a young person, you may really want to invest in a brokerage or 401k or IRA related asset. And if you are retirement age and looking to purchase or build a home that you'll eventually retire to, reach out to me. I'd love to help you and talk to you and walk you through potential solutions of how we can help you build or purchase that next home. So thank you for your time, and we hope you follow us, like and subscribe our videos, and we'll talk to you next week.